You say there's no doubt or no question that we are in an inflationary environment, but I guess the question is, how much longer will that last?
Well, that's entirely right, and that's the question that we're asking at Pella. We talk about data dependence, where you don't get more data, stronger data indications than what we've seen out of the US CPI for September and now the Chinese PPI. So there's clearly inflation. The real question is, how long will it last for? And that's a question that the Fed's grappling with. The reasons why it could be elevated is China is no longer exporting disinflation. We can see that in the numbers. There is massive liquidity in the systems, and there are real labor and infrastructure bottlenecks. The reasons why inflation might decline are we still are in an age of technological disruption, which is pushing down prices. The low labor participation rate in the US does signify or does demonstrate that we could easily get an increase in employment, which would push down wages there. And finally, who knows, maybe the supply chains could normalize. But regardless, we think it's prudent to operate on the basis that inflation's here to stay, which means interest rates are likely to increase, which would be a very severe outcome for many, many asset markets, particularly the fast-growing darlings in the market.
Right. So you say that you're treating inflation then as a risk going forward. It's going to add to volatility. So how do you trade that risk and volatility? I note that you say you look at, we're going to go through a few of them, but first off, the derivatives exchanges. Why?
Yeah, these are magnificent businesses. So it's a company like CME Group in the US and Deutsche Börse in Europe. And at the end of the day, derivative exchanges are the places you go to buy and sell derivatives or insurance against the unknown. And the greater volatility there is, the more unknown there is, and that will bring more participants into the market. So volatility is a very, very good thing for derivative exchanges, and an increase in interest rates creates that volatility, which should be very profitable for them. Also bear in mind they've got fixed costs, so their costs don't go up with that increased trading volume, just their revenue. So they are fantastic plays on increased volatility and uncertainty.